G'day guys, it's Crypto Trader Vader here, and recently I had the opportunity to interview Doug from digitalcurrencytraders.com, where I was able to ask him some questions about trading psychology, about kind of how his bankroll works and how he ensures that he keeps on learning and keeps on improving. So here's clip one of that interview. A lot of people make mistakes, particularly in bear markets, and there's even more mistakes that are made, obviously, in bull markets as well, where people aren't taking profits or they're dumping their life savings on it. I guess I'm curious, from your perspective, what some of the biggest mistakes are out there, maybe mistakes that you've made, and how you correct that. How do you fix that?
Well, thanks for having me on to your YouTube channel, Vader. I really like watching your videos and your analysis of the charts, and appreciate the audience to speak to a few more people on this stuff. There are tons of people who are putting out videos on YouTube about cryptocurrency trading, but when I watch many of them, there are lots of opinion videos about the projects themselves, and there's no systematic way of approaching trading that is going to give you free time in your life. I see a lot of people tuned into the 5-minute bars, and that's when you are whale food. You're so close to the market that the manipulators can actually hit your stop losses and take you out. So the psychology of trading and stuff like that has been important for me, even way back when I first started, 1995 to 1998. I did some trading in the commodities market, and I lost all my money instantly, twice, after really working hard to put a stake together and putting my money in there. So that was a painful lesson for me. And it didn't deter me, though. I kept studying on all of the commodities and chart patterns. And some more about the psychology of trading and a painful lesson. Back in 1990, a friend of mine committed suicide, and he and I were close friends in trading. And he was trading with real money. I was trading with paper money. And he blew out his account twice. And on the second time, he shot himself. So it was many years before I really got back to thinking about trading again. After that, it was quite a punch to the stomach, for sure, even now, all these years later. So I always keep those things in mind when I approach trading. And because I had these hard lessons, I went and studied a lot about risk control and getting together a system so that I would protect myself from those kind of big losses that are so completely demoralizing for many people. So I'm happy to be on here and answering some questions you might have about that stuff, and see if it might help some other people. And it also helps clarify things for me so that I make less mistakes in my own trading.
Wow, yeah, that's incredible. I had no idea about that. I guess it's really testament to the extremes of emotions that traders can feel, during the ups and downs of the markets. And of course, losing big sums of money, or sums of money that you've saved up for a long time. I'm curious, when you started, you mentioned you blew out your account twice trading commodities. Like, what was your mindset going into that? Did you think that it was easy? Did you think that you could beat it somehow? What was your mentality there? Because I imagine a lot of traders starting in cryptos are having those same thoughts.
Well, there's a lot bigger barrier to entry to get into the commodities trading. So I did a lot of paper trading beforehand. I studied the markets. I ordered all sorts of pamphlets and books from the commodities exchanges, and I read everything that they said about them, and I got myself all prepared. I put in a couple $1,000s into the market, and a couple $1,000s in commodities trading is enough for one small contract. And if that contract moves against you in the smallest amount, then you're wiped out. That wipes out your entire amount of money. So in effect, what I was doing was trading with far too large of a position for my account. And because I didn't have enough room for the market to move at all, I was immediately stopped out, and it took virtually all my money. And so I was over trading, and my position size was too large for the amount of money I had.
Yeah, fair enough.
So
No,
The second time, it was much the same thing. I got money together, I put it in there, and I did much the same thing because I hadn't learned my lesson yet. I hadn't learned about risk control and the psychology of how to pay attention to that.
So that lesson of risk control, the lesson of ensuring that you have a big enough buffer to take the losses initially if the market moves against you, was that like was that purely an education piece that once it was implanted is suddenly there and you're able to do it, or is it something that you still kind of have to fight with?
Yeah, it's not something I fight with anymore, but I do have a plan for it so that if, say, I was investing with one Bitcoin, I could only take 20% of that for any one coin, generally as a rule. So it keeps me diversified, but also that I only allow that trade to go down by 2% before I'm getting out of that trade, and hopefully a lot sooner than that 2%. So what I had to learn was risk control, and I was working through some online forums in 1997, and I was working with Art Simpson and another guy called Phantom of the Pits, and they were posting trading psychology, trading plans on the futures trading forum at that time, Futures Talk, I think it was. And that became the basis of my risk control rules ever since that time. They published a book called Phantom of the Pits. You can find it on Google, just search online and you can find a copy of it. And in there, he talked about risk control rules that changed the rules of an unfavorable game into your favor a little bit better. And ever since that time, I've been practicing those risk control rules.